scared. And this is something I've been talking about for many months. And I'm just quite disheartened that the news and the media doesn't talk about this employee retention credit. It came about in the CARES Act last year, and you can only choose between PPP or this employee retention credit. So most people went the PPP route. Then in December, the Consolidated Appropriations Act expanded and modified this where you can do both. And then the American Rescue Plan Act expanded it even further, and we'll talk about that. Before I jump in, and this is just going to be a quick 5-minute overview to give you information. I've done half-hour and 1-hour topics on this, so there is a lot of information. I did want to point out the second draw PPP. In the first round, many nonprofits were excluded from being able to get the PPP loan. So the Consolidated Appropriations Act that was passed in December expanded it to more nonprofit organization types. So if you were rejected before or didn't think you were able to get a PPP, this may be your final opportunity to jump in. You do have a couple of qualifications there. You needed to have a 25% reduction. But my point on this is if you were rejected previously, reach out to your bank because it's quite possible you are now eligible. All right, so the employee retention credit or employee retention tax credit, I think it's a horrible name also for what they called it. It is a refund based on wages you pay your employees. It really has nothing to do with payroll taxes. It's reported on a payroll tax return, but that's kind of beside the point. It's money that you will be sent. You do need to meet one of two different qualifications. Your business had to have been partially or fully suspended by a government order, or your business gross receipts must have decreased in a calendar quarter. And if you can meet one of these qualifications, you're eligible for up to $33,000 per employee. So if you have 10 employees, you could likely get $330,000 mailed to you in a check. The full or partial suspension is by any government order. Could be federal, county, state, local. And it's a kind of a broad statement of full or partial suspension. We know full suspension is your business was shut down and you're not allowed to open. So many movie theaters and businesses like that. But the partial suspension is not a gray area, but it's an area that has a lot of play in it. So if you have a nonprofit and part of that, you have a store where you sell items. And that store is located in a mall or located somewhere where it was unable to open. And that store may not have been the major part of your business. You get a lot of your business from fundraising and donations, but the store is to sell items. Because that store is closed or partially or suspended, you are eligible for this credit. So it's kind of interesting. We did a nonprofit that does dental cleaning for those in need. They do dental cleaning. And one of the government orders that came out in the state said elective dental work, cleanings and whitenings and that type of work, they couldn't do. They had to conserve PPE back in the early days. So there was a couple of month period where they could not perform one of their work. And they really didn't get revenue from that. They got donations and they provided it. But that was a way that they met the suspension. The other way is through a business revenue drop, and we'll talk about that because this is a bit complicated. The rules are different for 2020 as they are for 2021. So this is for 2020. Your business must have had 100 or less full-time workers, not to be confused with full-time equivalent. This is actual people that work full-time. So you can have 150 people, but if they're all temporary volunteers, those 50 people may not count and you may be less than 100. Your business must have been suspended. We talked about that. Or your gross receipts must be down at least 50%. And for a nonprofit, gross receipts is all revenue that the business receives. So whether it was donations or grants or interest or sale of product. If you meet one of those two conditions, the credit is half of the employee's wages you paid during that time up to $5,000. So if you pay an employee $10,000 during a quarter when you had a 50% decrease, you're going to get $5,000 for that person. Plain and simple. Now, there's a little bit of complication we'll talk about on the next slide. It's $5,000. For 2021, it is easier to obtain. They have made it available for larger businesses. So if you have 500 or less full-time employees, so many of the larger businesses are now eligible. Suspended, that's still in play. Or your revenue only had to have been down by 20% opposed to 50. So it's easier to meet this revenue qualification in 2021. The amount that is available to you is now 70% of the wages you pay your employees, up to $7,000 per person per quarter. So if you are floating along 2021 and your gross receipts, your revenue is down 25%, 30%, 21%, you are going to get up to $7,000 per person. And that is just an enormous amount that you'll receive back. The way you receive it back is this is filed on your payroll tax return. So sometimes we get some nonprofits that will say, well, we don't pay taxes, we're tax exempt. Well, you do pay payroll taxes, and that's where this credit is posted. And the amount of the credit will certainly exceed the amount of taxes you have. So that's why I think the name of it is just poorly worded. But it goes on your 941 return that's filed with the IRS. Once they process it, they will mail you a check. There's no requirement to spend it. It's just your money. It is a little bit tricky in calculating it that there's a lot of things that are excluded from what they call wages. So severance pay, the name of it is employee retention credit. So severance, you obviously didn't retain the employee if you're laying them off. So you don't count severance pay. And the biggest misconception is that you can't do this if you did PPP. That was a limitation back in the CARES Act. But now all the Act revised says is that the wages can't overlap. So if you received a PPP loan and you paid your employees with PPP funds, you just can't count those funds as wages you paid the employee because it wasn't your money. Same thing goes with these other items is workforce opportunity tax credit, families first. These are all wages you paid your employees, but you were able to get another tax credit somewhere else. So the IRS doesn't want you to double dip. Oops. And there's a couple of inclusions. You know, if you're self-employed and you pay yourself wages, it's really not employee retention credit if you're paying yourself, so you can't count that. Household employers are, you know, they're not included. But it is it's a little bit complicated. It may be time consuming, but the end result is very surprising. And we are finding companies easily $10,000, $50,000, $100,000 that they did not know they had coming to them until we educated on them on this.